This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. I have with me again this morning John Rubino, well-known author and publisher of the website dollarcollapse.com. Welcome back, John.
Hey, Gord. Good to be back. Happy holidays.
I hope it's going to be a good Christmas and holiday season for yourself. Any plans?
Lots of family stuff this time around, so which means I'm going to be really busy. Takes 2 days just to get the house ready for visitors.
I know the feeling well. John, we're going to talk hopefully today about what's going on in the junk bond market, what's going on in the credit market associated with, we talked about a credit cycle reversal or change here. But last time we talked, you were, and it was 60 days ago, we missed last month, you were warning, and we have a chart about the concerns you had in the junk bond market, and sure enough, it's come to fruition in a big way here. And we'll go through some charts on it. But you've also just recently put out 3 articles on the subject. I have them up here on the screen now. And I wonder if we could just use that as a kind of foundation, because you made a lot of good points in those articles, and to begin the discussion on junk bonds. John, I have the first one up now, and it's this is how fast it's happening, and just showing how quickly this suddenly developed here with a chart.
Yeah, junk bonds, I think, are one of the 2 or 3 big stories that are out there right now. And a little background to begin with. Junk bonds are loans to companies that are kind of risky for one reason or another. And so because they're risky, they have to pay up. So junk bonds are also called high yield debt, meaning that they pay a pretty good interest rate. And in good times, people get suckered into these things because they look like they have a relatively low risk yield that dwarfs treasury bonds or bank accounts. And this time around was no exception. Individuals who can't make anything in their bank accounts and pension funds that have to generate 8% returns in order to meet their obligations all piled into junk bonds in the last couple of years. And in 2014, the yield on junk bonds dropped to about 6%, which is really historically low, meaning tons of money was flowing into that sector. And that's usually a danger sign, and it's worked out that way again this time around. In the last year, largely because oil prices have tanked, which is making a lot of the junk bonds generated in the oil patch untenable and soon to default. The junk bond market is starting to roll over. And so junk bonds have spiked and defaults are picking up and money's pouring out of junk bond mutual funds. And a few of the funds have actually failed, and one of them is refusing to give back the money that investors put into it. It's just basically closed the window until it can liquidate all the bonds that it owns. So it's got everybody spooked. And the reason this is important is that junk bonds are a leading indicator for the overall financial markets because they're basically the equity of junk bond issuers. In other words, they trade like stocks, and so they tend to lead the stock market overall. And that's the way it's working out. Junk bonds tanked while stocks continued to go up for a while. And now the big equity indexes in the U.S. are starting to roll over. The S&P 500 is down more than 1% 2 days in a row here, and not looking like it's going to improve anytime soon. So if junk bonds turn out to be the leading indicator that tells us a new bear market is starting, then it's really important that we pay attention to it now, because it's what's happening there, what's happening in junk bonds, will be what happens in stocks in January, February, and March of next year.
Well, we're seeing it explode right from junk bonds, the worst, all the way up through investment grade or CCs to investment grade bonds. We're now into where we're seeing it in CLOs, credit loan obligations, and I'm starting to see it on the dividend-paying stocks on the edge there. I'm thinking of Morgan Kinder and some of these other energy stocks. So it's only a matter of time if it sustains itself. And John, but I don't think people realize that the Fed has put $3.5 trillion on their balance sheet in the last 7 years, but 2.2 trillion of new junk bonds have been issued in that same period of time. I'm not saying that is not the direct correlation, but there is an overlap. That 3.5 trillion allowed 2.2 trillion to be put out there, and funds have bought 240 billion of it, probably 60 billion in ETFs. So there's 300 billion of it that's in funds where there's an expectation I can trade very, very quickly. That's I think problematic with the investors. But when I take that 2.2 trillion in bonds, take out the 300 billion in funds, that means that people seeking yield, such as pension plans, insurance companies, own 1.9 trillion dollars of that. That's going to affect stocks eventually.
Oh yeah, yeah, and wow, there's so much in what you just said. Let me start with the fact that so many of the junk bonds that are out there are energy related in one way or another, and they were mostly issued with the assumption of $100 a barrel oil. So now that oil is down to $34 a barrel today, a lot of these bonds are guaranteed to default in the year ahead. In other words, the companies that issued the bonds aren't generating enough cash flow to pay off their interest. And so we're going to see a lot of rolling explosions in the energy market in the year ahead. And that's going to reverberate through the junk bond funds, which is going to make outflows even more dramatic in the year ahead. So the junk story is just beginning. And you mentioned dividend paying stocks. See, that's a market that's similar to junk bonds in the sense that when people can't generate enough interest to meet their needs from very safe instruments like bank CDs or treasury bonds, they move out on the risk spectrum and look for other things to generate yield. Junk bonds are one, and dividend-paying stocks are another. People look at these big blue-chip stocks that have 4% dividend yields and think, well, this is a safe investment. But it's actually not, because stocks fluctuate dramatically. And a lot of the big dividend-paying stocks were energy-related over the last few years. And so people have poured into oil companies and gas pipelines and related kinds of companies that had huge dividends, 5, 6, 7, 8% a year or two ago. And now they're all cutting their dividends. You mentioned Kinder Morgan before we went live here. And that was a big gas pipeline stock, or it is a big gas pipeline stock that had a really nice dividend yield. And now it doesn't anymore. It cut its dividend back to next to nothing. And so all these retirees and pension funds that thought they were locking in pretty good returns suddenly find themselves back in bank CD territory where they're making next to nothing on their money. And it's not enough in the case of retirees, it's frequently not enough for them to survive on their income. And for pension funds, it's not enough to cover their obligations going forward. So they have to figure out some other way of satisfying their obligations. And who knows what they'll do now, because there's not really anything left that generates a lot of yield. So you're seeing a lot of different people be hurt by this who shouldn't be hurt, who don't deserve to be hurt, but it's been government policy to force down interest rates and push people further and further out on the risk spectrum. And basically what we've been doing for the last 4 or 5 years is shifting wealth from retirees and pension funds into the hands of leveraged speculators. In other words, it's been the 1% sucking wealth out of the rest of us for quite a while now. And it's been explicit government policy to make that possible. So now it's starting to blow up on us. So this is a big sea change because it's happening as the Fed raises interest rates. And the assumption that the Fed is making, at least publicly, is that the economy is growing again. And so now it's time to start bringing interest rates back to normal levels. But the fact is the economy is not growing by most of the measures that you see out there. The number of bad economic reports that have come out in just the last week are staggering. If you just looked at those reports, if you ignored the kind of make-believe numbers that the government puts out for employment and GDP, and looked at these other underlying numbers, you would say that the world is headed back into a recession. So let me just throw out a few of the things that came out very, very recently. Oil plunged, of course, And gas is down to levels that, natural gas, down to levels that last prevailed during George W. Bush's administration. So it's at near record lows for recent times. Japan just reported that its exports fell 3.3%. That's an export-driven economy. And the Japanese central bank just increased its quantitative easing, and the government increased its deficit spending to stimulate the economy. So they're responding to what they're seeing, like they're in a slowdown. U.S. manufacturing is now in contraction. All the regional Fed surveys that come out monthly are showing negative numbers. In other words, the regional Fed indexes are in contraction, which means that industrial production in the U.S. is going to go down. Corporate profits, which is really the driver of equity prices in the long run, they're now falling at a 5% annual rate in the U.S. if you use generally accepted accounting principles rather than the make-believe numbers that the corporations put up there. And for hedge funds, the third quarter was one of their worst ones in the last 5 or 6 years. In other words, they didn't make any money or they lost money, depending on the hedge fund, in the third quarter. And that was before the junk bond market blew up, which is crushing a bunch of hedge funds right now. So almost across the board, the U.S. economy and the global economy are very, very weak and possibly in recession. So normally, you would see the central bank respond to that by instituting a new quantitative easing program or doing some other kind of thing that eases monetary conditions. And you'd see the federal government increase its deficit spending to lean against a downturn. But we're at a point now where the Fed just raised interest rates a couple of days ago, and so they're not going to help anytime soon. You know, it's going to take a big crisis for them to reverse course. And the markets are starting to figure that out. You know, stocks in the U.S. popped during the 2 days that the Fed was meeting, which is what they always do. But the very next day, the markets tanked, and now they're down again big today. So we're seeing two 1 point plus or 1% plus drops in the big U.S. stock indices, and a lot more serious drops in some of the sectors out there. And the reason for that is that people are figuring out that the Fed isn't going to help, and these numbers are actually weak and getting weaker. And so we might drop into a recession. Certainly we'll drop into a corporate profits recession in the year ahead. And we're not going to get any immediate help from the Fed, which is what the leveraged speculating community has come to expect over the last 20 years. You know, starting in the mid-90s under Alan Greenspan, every time there was a crisis, the Fed responded with lower interest rates and aggressive monetary ease. And now we're not going to see that right away. We're actually going to see tightening on the part of the Fed for at least a few more months before they reverse course. So the markets are spooked. And spooked markets kind of, they reinforce a downtrend in the real economy. And so that's what
John, what you said is right at the essence that the Fed, for at least a few more months, the Fed is not going to loosen. They're going to be perceived as tightening or staying where they are right now. And we've got, going back to our junk bond discussion and the credit cycle, we've got this month alone $5.5 billion in bonds that are defaulting right in real time. We've got Fitch saying right now the default rate's 3.3. It's going to be 4.5% next year. They're calling for 11% default rate on the energy sector bonds that are out there, and these are industries that are capital intensive and therefore need the bonds. That's where they float, and they're the ones that pay the dividends. So there's hurting, but where it's rolling around to is the stock market's been held up with buybacks. So suddenly credit ratings are now in jeopardy as it's moving up through the high into the investment grade bonds. So people like IBM that have been buying, and they're just an example, buying back quite literally billions and billions of dollars worth. They got a large amount of debt. Debt got more expensive. They're going to have to slow down their buybacks in a lot of them. And that's what's that money from that for buybacks and dividends is what's been keeping the market up. So if the Fed, what I'm saying is that this is absolutely the wrong time for the Fed to be doing it. They should have did it 2 years ago, in my opinion, and it just could get very quickly out of control if they don't watch it, or they're going to be forced to do something, in my opinion. That's the story that's not being understood right now, the significance in the shift in the credit cycle. Because the credit cycle has turned. That's what we should really understand here. And it leads the stock market. And the credit market has turned, John, in my opinion, because we've had three quarters of down revenues. We've had 2 quarters of down earnings, but more importantly, cash flows are down. Free cash flows are falling, and debt is up. And the credit guys have to take down the credit. It's mathematics to them. The credit's down. They don't get emotional about this, so they take it down, and everything flows from it. And we're, and as you said, tenuous situation.
Yeah, yeah. Corporations have spent the last few years leveraging themselves to the hilt to buy back their own stock, and in that way they mask weak earnings, because you change the denominator when you pull shares out of the market for your earnings per share calculation. But yeah, now even Apple is looking at possibly flat iPhone sales in the year ahead, which is shocking. You know, they increased their iPhone sales by like 35% in the previous year. The year in prospect now is looking up 3 or 4%, and maybe not even that. And so a lot of these big companies are, you know, they're seeing the effects of a slowing global economy. They're not generating the sales that they used to.
Well, John, as you on Apple, 20% of the market's profits have been Apple. And suddenly they're not there. And by the way, there's 9 stocks that they call them the Nifty 9 or Fang and Nosh, if you go through them, that really are not that spectacular, but they're holding up the market. You take them out, most of the companies are down around their 200-day trade moving average or lower, which says breadth. We haven't seen breadth this week in a long time.
Yeah, Gordon, you and I are old enough to remember 1999 when the global economy depended on the U.S. stock market. The U.S. stock market depended on about 20 tech stocks, most of whom didn't even have any earnings, but they had just massive dollars in stock price per dollar of sales. You know, they were trading at insane multiples.
We had the four horsemen in 1999: Microsoft, Intel, Cisco, and Qualcomm. And they were carrying the market at the end. And we also, everybody said, oh no, they're the future. May have been. We know what happened.
Yeah. When they cracked, not only did the U.S. stock market fall, but the whole global economy got pulled down by that. And we're kind of back in that place again, because really the U.S. economy is the only one that is even pretending to be growing at a steady pace. You know, nobody trusts China's numbers. And in reality, the underlying statistics in China are pretty much flat to negative, and the whole rest of the world is either flat or in recession right now. So only the U.S. looks like it's growing, and we're not really.
John, have you looked at rail traffic volumes? Have you looked at shipping volumes in the United States? And the global Baltic dry rate is at a 30-year low. Matter of fact, last week they turned around 3 ships in mid-Atlantic and brought them back to the Gulf because it wasn't worth sending them the rest of the way across the Atlantic.
Yeah, we've got loaded up oil tankers now wandering around the ocean with no place to put their oil because the terrestrial storage is so full.
Right.
And normally that kind of a glut precedes a big drop in price. So we could see oil drop to, you know, $25, $20 a barrel in the year ahead, which you would think would be a good thing for consumers, which it is. It's like a tax cut for regular people who drive to work, but it's a catastrophe for the leveraged speculating community. And because the speculators are really the tail that wags the dog right now in the global economy, if the hedge funds get crushed by falling oil prices, takes down everything else, because they're going to have to then sell whatever they can sell. So that, you know, if you've got Google stock, which is at a near record level, and your oil plays are being crushed and you're seeing redemptions and you've got to raise cash, what are you going to sell? Google, of course, because that's where you can get cash in a hurry. So leveraged plays blowing up in the energy sector will lead to a generalized bear market, just because there's nothing left for the hedge funds to sell to raise cash except the high flyers that we just talked about. So this is potentially a very big deal. And it's just one thing. I mean, energy is maybe the most visible problem that the world has right now, but it's just one of like 10 different problems that are out there, all of which could be fairly serious crises. And there's no way to know which one blows up first.
John, I got up a chart right now that shows all of the sectors out there. And they've all got, maybe not as bad as in the mining, the commodities and energy, but they've got similar problems. And we're not talking even about emerging markets and a lot of these sovereigns. I believe there's peripheral sovereigns that are going to have serious problems because of the strengthening U.S. dollar. And it only holds the dollar up with this apparent Fed tightening when you've got the EU reducing. The Japan continuing to reduce. It puts pressure on the U.S. dollar, and you've got $9 trillion on the wrong side of the carry trade in these emerging markets. This is pain.
Yeah, we've been talking about that $9 trillion for about a year now, and it hasn't become front page news yet. But at some point, it's got to, because most of these deals that they did by borrowing dollars and investing in local currency generating projects around the world, they're underwater, and they're generating negative cash flow in a lot of cases, or certainly inadequate cash flow to pay off their dollar denominated debts. So these things are going to start blowing up pretty soon too. And a lot of them were energy related.
Well, think of how many of the OPEC nations, and I'm not picking on Venezuela, but Saudi Arabia, that's such a huge part of their current account, and it's in a negative position. They're spending more money than they're getting in oil revenues right now, so they're having to sell assets, or they're floating bond. They were floating bonds to raise the money. Now they're going to have to sell assets. Doesn't that hurt the liquidity drain? Isn't that a liquidity drain globally?
What they're going to sell is treasury bonds,
right?
Mostly.
And have you noticed treasury bonds? The sales. So these are precursors, right, John? It says, in my opinion, something's broken out there, and it's going to come to fruition. I was interviewing Ira Harris the other day, famous trader up in Chicago, and he was buried. And Ira says something's broken somewhere, and I'm trying to figure out where, but I smell it.
Yeah, well, right now we're seeing everybody
like an LTCM is what he was referring to.
Yeah. Yeah. Some big hedge fund that's ready to blow up. Oh, without a doubt, there are going to be hedge funds blowing up all over the place, and some of them might be big. Some of the ones that are in trouble right now are pretty big. You're seeing.
Third Avenue is a big one, and there's been three of them that have gated. They've either gated taking out or are folding and returning what they got.
There are some hedge funds that are considerably bigger than that, and some of their sub funds, some of their sector plays, are in deep trouble right now, and so you could easily see a fund that's part of a big fund family get into trouble, and that leads to redemptions in the other funds, because all people see is the name of the fund family that has a big problem, and that starts the ball rolling and impairs the whole fund family, and that's a possibility too, where you see redemptions start in one small problem fund and then spread to the others, and impair a major fund name out there. Right now we're seeing, for instance, Einhorn's fund, Greenlight Capital, which had one down year in the last 15 or something like that, have a major down year this year. It's down by double digits overall. And several other funds that are in that category, that size, that level of prestige, are also way down for the year. So when you've got even the big, ultra high quality hedge funds losing money, that means a lot of the smaller guys are in very deep trouble and will be failing in the year ahead. So, we've got any number of things that can blow up out there. Some emerging market can't pay its dollar debts and defaults, or a couple of big hedge funds blow up, or junk bonds just continue to go down until the pain is spread so widely that you start seeing actual pension funds become front page news. There's a lot of things that can go wrong, and that leaves out geopolitics. We could have the Middle East blow up on us anytime here, and that affect the energy market one way or the other. There's no way to know exactly how this plays out, but we know that lots of things can blow up in the year ahead, and we're heading in that direction. Or you could just have a garden variety stock bear market. 20% drop in the S&P 500 might be systemically dangerous right now, because that's how fragile we are. And so there's no way to know what that does in concert with all these energy plays blowing up and junk bonds blowing up at the same time. We don't know what that'll do to the financial markets, but we know it won't be good. And we know it'll have impacts far beyond the sectors that are immediately blowing up. So 2016 is going to be a really interesting year. And I mean that in the Chinese curse sense for most people, because it's going to be very painful for almost everybody, but at the same time really fascinating from a financial theory standpoint, because we basically tested the envelope here. You know, we've pushed leverage as far as we can push it, I think. And we're finding that out now. You know, and what happens when you leverage basically everything in the global economy to unsustainable levels? Well, we've done that. Now we'll find out what happens.
Yeah, Tim Price said to me a year ago, and he was warning about a lot of these problems, and Tim's in Britain, and I says, well, it's like a theater. Everybody's waiting for somebody to yell fire, but everybody's real close to the door. He says it's going to be different this time. He says the door is going to be locked, and the only way you get out is you got to exchange your seat with somebody who's out of the theater. And he says the chance of somebody wanting to go in the theater is going to be slim to none. You're not going to get out. And it's not just timing. And what we're seeing, and he was referring to the junk bond, the ETFs and junk in junks in the bond market. There's just no liquidity. You can sell it on your screen, but they can't transact it. So there's going to be more gating and these kinds of problems, which we're already seeing surface.
One of my first finance jobs was as a junior junk bond analyst in 1989, just as that market blew up. And that's exactly what happens. A lot of the funds that own high yield bonds can't own defaulted bonds. So the minute a issuer defaults, all of these funds have to dump their bonds at any price. And the price is minuscule in that kind of a situation. You know, if you got something that's worth 60 cents on the dollar, nobody's going to pay you even 20 cents on the dollar for it when and if. And so that's what's going to happen out there. You're going to see a run on these bonds, and you're going to see basically air pockets under the prices of them. And that's what happened then. That's what will happen now. So pretty soon is going to be a good time to open a distressed credit fund when you can be the guy buying these things for 20 cents on the dollar.
Yeah, the thing that's moving right now is distressed funds.
Mm-hmm.
And
yeah,
that as an opportunity, clearly.
But I don't think that.
Yeah, John, I don't believe this is the big kahuna in terms of a collapsing market. As negative as we kind of been here this morning with all of these issues, I do think there's going to be some real strong currency in here short term. But I think, let's say that it's held to 1,800 on the S&P as a drop, which is pretty hard hitting. But somewhere in there, the Fed and the central banks will react, and there's more policies that they're going to come with. And it's not just another quantitative easing, whether it's helicopter money we've talked about previously, whether it's negative interest rate. There's more things, quivers in their basket, or in their arrows in their quiver, to be able to turn things around sort of in the short term. But it's only buying them a little bit more time. 2016 is going to be a very, very challenging year. What's your views on that?
No, I agree that they're going to come out with a new set of experimental policies in response to the failure of the last set. And so then it becomes a question of whether the market believes that it's going to work this time. And it didn't work.
That's the issue, because they're losing credibility. And I think even the public is starting not to believe. The politicians are don't believe them as much anymore. That's going to be the thing that really breaks them. And they won't be given the opportunity for more experiments. But there will be a crisis that will unfold that will force the hand at some point, even after that.
That's the thing, because the Fed can't turn on a dime this time, because they've really boxed themselves into this interest rate increase and a few more after that. So it's got to be a major crisis to convince the Fed to say, oh, okay, instead of raising interest rates next time, we'll cut them to negative levels and we'll increase QE. That's got to be a big, big crisis.
And I agree with that. And the difference with 2008 was where the Fed could react. I believe when the crisis really unfolds, it's going to be global, and the issue is going to be coordination amongst the central banks. And we've got a poor track record of that kind of coordination. Right now, we've got some countries tightening, some countries, areas easing, like the EU, we're tightening. So that's going to be the real challenge when that crisis hits somewhere out in the future. It's coming. We'll just speculate on when.
Yeah, Agreed. We'll have a lot to talk about in the meantime.
John, any closing comments you'd like to leave with our listeners?
No, Gordon, I think we've covered it in general pretty well. 2016 is going to be a fascinating year and probably a kind of crazy one for the first 3 to 6 months. So we're heading into one of those times when you want to wake up early and see what happened during the night, because it's almost always going to be something crazy somewhere going on. So it's going to be a fascinating time for finance geeks like us. These are the kind of times that we lose.
We're going to continue to have lots to talk about. John, you have a podcast series that you're going to start. You want to mention that to our listeners?
That's right, Gord. I'm finally joining you on the cutting edge of technology. I'm going to start a podcast series that'll be about once a week, where it's just going to be audio, not video like this, but I'll just come on, talk about what's going on, and post it on iTunes. So the first one will come out this week, and it'll be about once a week thereafter. And to get on the mailing list for it, send a note to info@dollarclaps.com, and I'll put you on the list.
John, all the best of the season for you, and a good time with the family.
Thanks, Gord. You too.
Talk to you again next month. Bye.
Okay.